live. Adică să-mi zici cu 10 secunde înainte.
La tine a făcut probă de
Că
sună.
dacă
Nu știu. Spuneți-mi dacă se aude și vocea mea.
Acum te aud și eu
Da.
prin microfonul ei,
Ok, ok.
deci se aude. Ne auzim amândoi bine, nu?
E suavă? Dacă e suavă vocea.
Suavă. Da. Numai să nu uiți să dai... Da. Să zici și să nu uiți să dai mute, că eu mă aud pe mine și very
E fix
confusing.
de ca. Deci suntem live de 36 de secunde.
Mhm. Da? Hi everyone. We're here with Remus Rădvan to talk about landing a strategic investor. But a few words about Remus. First of all, I think one of your main attributes is that you're going to be a speaker at our conference later this month, Invest in Unicorns. That's the first educational conference dedicated to angel investment. The agenda covers all phases of the investment process, from sourcing to picking to winning. We're going to have 30 speakers on stage, sharing expertise, sharing success stories. And on the second day, we're going to see some wonderful sculpture by Constantin Brâncuș. Given that Timișoara is cultural capital this year. And we're in a very novel location.
Yes.
At Faber, which is very dear to our hearts, and an organization that's close to Grăuceanu. In fact, it was co-founded by a bunch of our own co-founders. So aside from just being from being a speaker in our conference, you are also, I'm going to talk about myself now. You were also my student at
Yes,
some point.
I was.
When I was in academia as well. And during your student years, you had some amazing achievements. You started a number of initiatives with student organizations and other students, and one in particular that I think all of us are really particularly proud of is Minds Hub, which is an amazing space in the basement of the Faculty of Economics.
Yeah.
Amazing because it's so creative, because it was designed and built with so many different users in mind, and with support from so many companies and so many sources. So you did all that, and then you went off to London.
Yes.
And there you had an entrepreneurial track of your own.
Yeah.
And then you joined Telefonica and Wayra, where you're working with startups. So maybe tell us a little bit about that, what you did after you graduated UCL. And then let's move forward and talk about what Wayra does and so on. But tell us a little bit about yourself.
Thanks, Chip. And yes, I was grateful to be your student once back in the days. It was very impactful to have you as a professor. After I graduated UCL, the first thing I did actually was to remain in the teaching staff of one of my mentors, it's Ashley Del Palacio, in the venture capital module, because she really helped me understand the venture space outside the entrepreneurial spectrum, just understanding from their side as well. And that really gave me an increased passion into this space, and said this is the place to be. So when I put my entrepreneurial boots off, I joined a number of investment organizations or venture building organizations, from a family office up to a company builder, entrepreneur first, and most recently at Wayra, where I work at the intersection between corporates, startups, and investors. And it's quite joyful. I really like this playground, and hopefully I'll be here for a long time. So that's in a nutshell. I had an entrepreneurial career. Yes, I besides MindSap which was a social enterprise. I built other 7 ventures, failed 5, so only 2 of them remain up and exited. So yeah, that's so far about me.
Brilliant, thank you. I think, well, social enterprise, Faber is another
Yes.
great example of a social enterprise where the community kind of gets together and it's all about entrepreneurship and art, design and manufacturing, and also there's a bistro, and of course it's a social, it has a social dimension itself, and there are a bunch of other social enterprises all around us, part of this structure as well. So social entrepreneurship is and has been an important part of your life. But then you join Wayra, like you told us. What does Wayra do?
Wayra,
Why are you there?
why am I there?
Right.
Because I really enjoy supporting both founders and corporates work together. We used to say in the past that you have a gazelle, the startup, and an elephant, the corporate. It's very difficult being such different organizations to work together. And someone who has spent some time in the corporate life and an entrepreneurial life can be very valuable in this relationship. And in a nutshell, what we do, we like saying that we solve corporate problems through startups. We like identifying the best ones that are worth solving with startups, identify the right startups to solve them, run proof of concepts, and invest in the most prolific partnerships that we design together. We are part of Telefónica's open innovation arm, and Wayra is one of the vehicles that is focused on pre-Series A companies, and it's very focused on driving that strategic focus and business development efforts to support the startups to land in Telefónica's ecosystem and create value there. There is another vehicle as well, Telefonica Ventures, was a traditional corporate venture capital arm, but they do bigger investments at even later stages than we do.
Mhm.
So that's in a nutshell how we operate.
So you were in really early stage, and now you're in slightly later stage, having been an entrepreneur yourself as well. Kind of moving on to the conversation about strategic investors. How early should a founder think about their strategic investors? What does having a strategic investor mean? What's it good for? Let's start kind of as early as possible in terms of thinking about the strategic investment.
Yeah, that's a good question, or set of questions. First of all, you're right. We did play at the earlier stage in the venture ladder. We played more with seed startups. We used to be an accelerator and even doing accelerator as a service for other corporates. But then we decided to move at this later stage. Series A is our sweet spot now, even though we did even Series B deals. So I can talk about both spectrums. So I think the earliest you can go and approach a strategic investor is when you might be even at idea stage or have a concept.
Really?
And you can even look for the venture builders, corporate venture builders. It's a very up and coming trend that's getting more and more traction, even though I haven't seen huge success cases yet. It's not that easy though, especially when it comes to governance, to risks, when corporates look at it, the talent that you invite to join the venture you're building. But that's still a shot to go after. You can, if you have that clear gap in the market, big problem you're going after, and you know that certain corporate would benefit out of it, would support you with resources, with knowledge, whatever you require, I would still go for it. And there are more and more corporate venture builders popping up, and even if it's at a service with an agency or that does this for them, or embedded inside the corporate, that's still a shot to go at a very early stage. Then secondly, you would find accelerators, and that's more when you established a bit of a concept product, MVP at least, and you can go to get access to a cohort of other founders trying to leverage the corporate resources. So you will receive more mentorship, tech stack, different toolkits to co-develop together your solution with the corporate. And that's quite valuable. Actually, it really accelerates your go-to market and infuse all of that knowledge that the corporate can offer you, the access, especially when it comes to proof of concept opportunities inside the corporate, or most of the times we've seen the model where corporates invite their strategic clients to co-develop together new solutions that involve startups. So that could be a way through. And then later on, you have another model which we also operate in. It's called venture client. It's basically a concept which makes the corporate be the best partner for a startup, and the startup the best vendor for a corporate. And that it got more and more traction in the last 3 to 5 years. And it's solely focused on the commercial. You don't have the investment discussion with this. And then lately you have the traditional corporate venture capital arms. I think I was looking at a report. I think 98% of most corporates out there from Fortune 500 have a corporate venture capital arm. The challenge that founders need to look at is how is the strategic value added to them once they receive the capital from the corporate. And then you sometimes have traditional VCs that have a corporate as LP, and I wouldn't call them strategic investors, but there's also, you know, an angle you can drive by knowing that information, which sometimes is not even public. But obviously those limited partners that invest in a traditional venture capital fund, and they are corporates, they would like to acquire some sort of strategic advantage besides the return of investment or traditional fund metrics. So in a nutshell, a strategic investor is something that probably every founder will look after. It's a investor that comes with value beyond capital, and that could be seen in various forms. Like you receive technology, you sell technology through the corporate sometimes as a go-to-market partner, and so many other models out there that you can collaborate with corporates, and that resource gives you, you know, a certainty that a big corporate acknowledges you as an up-and-coming market leader, and at some point, some of them even require a right of first refusal when an acquisition discussion comes in place. They acquire them.
Okay.
Hope I answered your question.
Yeah, I think so. And let's kind of go a bit deeper and change the angle and start looking at things from the founder's point of view. Founders, you know, I love it when they fantasize, but then they also turn into a reality, you know, this road to unicorn status. But these are very early stage companies in most cases that we look at. And we call them moonicorns because they're not there yet. They're still in the shadows.
Yeah.
So they think of all the elements of strategic elements that need to be in place. And I think, yes, you placed the strategic investor nicely somewhere along that roadmap. So maybe we can go into that a little bit and then start considering how one goes about finding the right strategic investor, how to approach them, and what to do, how to make use of them, you know, things like that. But first of all, finding this place, this positioning in on the roadmap to unicorn.
So, especially depends on the type of startup I would build. Let's say if I was, let's say hypothetically, I'm a founder right now, right?
Right.
I will try to understand my entire value chain, and as much as possible towards the destination I'm heading to. So I will map all of the big players, incumbent strategic corporates in that space that could serve me with technology or go to market, or even could be a potential acquirer for me. And I'll try to map them down. Then understand where is the value exchange with each one of them. Depends if they're multiple or only one set of partners. In my case, telecommunication, it's way more straightforward. And and try to understand what's the business case. What will be the value I will provide for them? Is there a gap in the market that it's still small enough, but I'm getting traction on it, and I believe that by growing this, I will help them fill in that gap? Yes. Then the next step I would do once I identify this initial business case is to go and validate it with the commercial and technical people inside the corporate. And most of them, especially the people who drive innovation, who drive, or if they have an open innovation arm, the better. And sometimes even through the corporate venture capital funds, you have a way in because they really understand your startup language, and they could open you doors, but ideally do it before. And once you validate this value exchange hypothesis you have, you try to put together a business case, how we can add value to each other, what I need, what the corporate could benefit, and then go to the venture capital arm and say, hey, I need this value from the corporate. I'm not there yet, but this is with your capital. This is how far I can get in my roadmap. And as soon as I get there, this is how beautiful will look for you, that you invested in me in at a very early stage. And yeah, that's how I would do it as a founder. It's not easy, obviously. In theory, everything is easy, but we all know it's not easy to drive enterprise partnerships. They're very risk adverse, which is normal. They're big organization. The decision process is very fragmented across different departments, and you will have to understand how to navigate these stakeholders. And there are a couple of good frameworks out there you can learn and adapt while you're going through this journey. So yeah, I hope I answered your question.
Yeah. I think we're getting there and narrowing in on the entrepreneur's journey towards this strategic investor. Does obviously it's about extra value other than just money.
Yeah.
So it's a little bit like a more of an angel VC, angel combined with a VC, with some very specific kinds of value that that different corporates can provide. But on the other hand, what do they look at? What does Wayra look at when talking to startups, both in terms of sourcing, the initial stages, what qualifies me as a founder to be interesting for you, and then further down the road, if an investment decision is made, what does due diligence look like?
Okay, so let's start what we're looking for. So 80% of our investments have to have a strategic fit before, or at least mapped out before we bring them to investment committee, and that requires a sponsor.
So the story needs to fit, whereas in Telefónica's story.
Yeah. So that requires a certain sponsor that will back this and will understand the technology and will give us the certainty that this is something
Can you give
valuable.
some examples?
So yes, for instance, what example should I pick? So let me give you an example with one of my favorites, which is called AirElo. It's even a consumer proposition. So AirElo is an app that you can use when you travel abroad, and especially if you go in a country where the roaming prices are crazy.
Yeah.
And you can use
roaming prices are always crazy, but
it depends,
except for inside the EU, right?
Yes. Yeah. So when you travel, you use the app. You buy a local eSIM with data. You install your eSIM, and that's a way more cost-effective way to communicate while you're abroad. And It sounds like a very simple proposition, and it's a very, very inspiring founder who put it together. And we invested in them during the pandemic. We knew somehow from inside that the eSIM adoption will increase more and more. And then obviously everyone have seen Apple, especially in the US, driving devices without a SIM slot. So it's clear that somehow the market sometime will get to that point where we'll never have a slot again. So we'll never look back. And we wanted to tap into that opportunity, learn and collaborate. And how we did collaborate is to offer them in various countries, especially from Telefónica's perspective in Latin America, where roamings were a bit more pricier than other parts of the world. So they're driving a multi-million revenue for Telefónica's connectivity products in those territories, and we're very proud of them. They increased their valuation from around to another. They just raised a big Series B. So yeah, it's an amazing success that we had so far.
Right.
And many others. I have, for instance, there's a voice security platform, a Series B company that we invested in, which helps us as users, as customers of a telco, to not receive all of those spam calls or SMS. It's called smishing now, SMS phishing, from random people we don't know about. And they have an AI engine that gets deployed to the network and protects all of the customers at once. And then how they make money, which is very interesting, they go to, for instance, my bank and allow them to be on the whitelist, and not only allowing them, but creating an interesting experience. So when I get called by the bank, I see the bank's logo, the reason of the call, and different other user experience options that I didn't have before. So that increased the customer experience even twice, while they make revenue from those corporates and share them with the telco. So many, as you can see, only
Right.
from one deal, there's so many angles you can add value and exchange it.
Yes. I mean, it doesn't take much to see the connection between the examples you gave and Telefonica and a large telco. Are there any examples that might not be so obvious?
Not be so obvious.
Like I'm wondering how far you can stray from the obvious contender, from being the obvious contender, in order to still receive some attention, if you can think of them. Otherwise,
Yeah,
maybe we go back to
I will start with the most obvious from the position I come from, because I see the business case being way easier defined, but it's not that obvious in the market, in the startup market, is to collaborate with a corporate to go to market together. And that's very interesting for everyone at the table. So
to piggyback, basically.
It's not piggyback.
No.
It's basically enriching the product portfolio that a corporate can deliver to their customers. So if I have a startup that complements what a corporate sells to the market, and myself as a startup and the corporate sell to the same customer segments that I'm going after, and obviously from my perspective, having a more innovative solution, I need some sort of validation or certainty to be at the table. So then I go to a corporate, I show the business case, I give them a share of the contracts they could help me deliver. The corporate increases the average contract value, sometimes the stickiness, sometimes the differentiation in the market, and I get a very good channel partner that drives me the sales I need to get to my next round. And this is especially important at Series A. And we all know that once you raise your Series A, the biggest challenge you have is to build your proper leadership team, especially the sales team. And you only have 2-3 opportunities to go wrong throughout your 12-18 months run rate of your round. So you need to be very quick on hiring and firing in case it doesn't work. So this is the less obvious one. Why wouldn't you focus to land a partner like this, who once established, they could drive the sales while you figure out your direct to enterprise channels? So yeah, that would be my favorite so far. And it doesn't require much integration, because the deeper you go into the core tech stack of a corporate, the more difficult it is to drive that in implementation and show the proof of concept. So I think that's another way of looking at it. If you can do that as a value-added service for a corporate, it's way more lucrative for everyone than trying to hit home at the core of the corporate products.
Well, and maybe then the next question would be whether sometimes conflicts don't arise, and how do you have any experience with that? How do you handle them?
Yes, and actually, one of the startups we're discussing right now has the same question we always receive. If Wayra or Telefonica invests in me, will I be able to work with other telcos in the space?
Right.
And actually, we have a case, this eSIM marketplace, Airelo,
Mhm.
that showcased the opposite. So we were one of the first ones alongside Rakuten to invest in them. And at their latest round, we had several other big telco corporates joining, including our Telefonica venture arm, including our other friends from Liberty Global, where Telefonica has partnered in the UK on a joint venture. Liberty Global Ventures invested in them. So that's an example that you just have to prove it. Then, if you're valuable enough, everyone will join. Of course, on certain territories, it might be more delicate to navigate, but at the same time, if you got on your cap table a corporate that with whom you haven't decided or agreed on the strategic value you're capturing back, and they're not offering you that value, then yes, you might be in a very conflictual situation where you're forced to go to their local competitor and drive that business with them if they're not able to deliver that. So it may happen. That's one type of common question I get. And of course, depends if the corporate is in the board or not in the board, their own interest to drive the next stages of the company compared to the traditional VCs of that cap table. And obviously, those board discussions are always uh, delicate and interesting. Hopefully, at the end, fruitful for everyone. And then another example I've seen is this right of first refusal that corporates put in their term sheet just to protect themselves from a competitor who could acquire them. So they should be asked first when it's an acquisition potential event.
Right. You don't want to raise this
Yeah.
baby and then somebody else to snatch it up just because they have a bit more money or they're
Exactly.
offering a bit more.
One interesting
Or-
other point to mention here is that especially it depends on the vehicle, right? If it's a big corporate venture capital arm, like let's say Microsoft Ventures, right? And you define valuation, that's a very important responsibility in the market, in both venture and commercial, because you're saying, hey, this corporate values this technology today at this amount. And that's something we at Wire are grateful for, because we have a very small ticket size up to 350,000, and we invest in 30 to sometimes 50 startups a year across all of the hubs. We have a presence wherever Telefonica has a presence, and obviously with that ticket size, we don't negotiate valuations. We sometimes do a convertible loan type of deal, and yeah, we don't get involved into that, because the last thing you want is a startup to go out there in the market and say, hey, you know, VCs, you didn't believe in me, but here's a corporate who valued my company at X money. So why don't you join on this, or just try to piggyback on that? And you wouldn't like to put at risk the reputation of a big corporate with something like this.
There are different kinds of strategic investors and corporates like this. Do you want to talk about more about that? Because I think the approach, the founder's approach to different types might differ as well.
Yes, and there's one that I haven't mentioned, and I had it in my mind. It's so related to Grow Channel and invest in unicorns, which is getting an individual, an angel that has been a corporate exec or
Right.
has lots of corporate contacts and experience. To get someone like that on your cap table could be very valuable, but at the same time, you have to be very careful with it. I mean, obviously, they join and they can bring capital on board, but one other model I see out there is some sort of option pool type of model, where you give them equity based on the performance they bring, like number of contracts, unfair advantages they bring from the corporates they have access to. And that's something I see more and more founders being careful, because again, last thing you want to do is to have someone that you have considered strategic at the beginning, and then down the line you didn't add any value at all for the startup. And more I see top tier VCs, especially in the earlier rounds, bringing co-founders or early team members of a unicorn, for instance, as an angel, a
Mhm.
strategic angel into a certain startup. They believe they're covering a gap into that space where that person could add tremendous value. And that could be on product, that could be, as I said, commercial, that could be um, directly on technical, very deep technical knowledge that they could bring. So these are some sort of individual strategic people you can bring on your cap table.
Mhm.
And the way to approach them, obviously, you have your capital, you have your cap table to share. So that's the pie everyone wants to be part of. It depends how you negotiate your terms. So that's on the individual side. I mentioned on the venture builder side.
Yep.
Then on the accelerator side, it's very straightforward because most of the time they post the challenges up front when they open the call to invite startups to apply, and that's the moment where you need to adapt your proposition to show that you could bring value and help them solve those challenges. And then, as I said, on the corporate venture capital funds, you need first to understand what's your strategic angle, because if you don't know your strategic angle, and of course you might not have enough information from the corporate side, but if you're not able at least to define a hypothesis, then it will be way harder for you to go through that door and ask if this makes sense or not for that corporate. So the first homework is on the founder side, and then you go and validate it on the corporate side. Yeah, that's in a nutshell.
Okay. Um, I had a a thought earlier when it comes to like applying to or pitching to the different potential strategic investors. What should a founder expect in terms of timing? How long does it take to get these people on board?
Yes.
You have talked already some about what to expect in terms of things other than money, and I think we can probably go as far as the time will allow us into that, because strategic investors will offer all kinds of other perks and advantages, and their experience and connections and strategic expertise, opportunities to sell things together and so on. But how long does it take? Is what I was asking. And you mentioned Wayra's ticket size. Do they differ enormously amongst different CVCs and
Yeah.
accelerators and so on?
Yes,
Right,
yes.
right.
It differs. It differs from fund to fund in terms of ticket size. Some of them could be funds on their own. But most of them, from my knowledge, are balance sheet investors. It depends if that unit is independent or it's linked to a different unit inside the corporate ladder under, I don't know, chief financial officer could be, sometimes straight under the CEO could be, chief strategy officer could be, chief digital officer. It differs from corporate to corporate, and depending on the on where are they placed in the org chart, you can imagine that the decision layer, decision process changes. So usually in our case, we're very fortunate because we have an investment committee that's quite straightforward. We actually invite the startup to pitch in the investment committee, which,
Okay.
from what I understand, most other CVCs don't do that. So we invite the startup. We have in the investment committee the right stakeholders that need to make a decision, and they pitch. We have a deliberation period afterwards, and we make the decision next day very quickly. Obviously, we do prepare a very comprehensive investment memo beforehand, with all of the insights and information we acquire from the startup and from our market research and understanding. That's being read before the IC, of course. So that's our investment process. Now, to build up that case,
Right.
it requires,
You're not talking about that much time
yeah,
for this
for this
for
piece, the
part,
closing,
right? The
and
closing.
then obviously you have compliance afterwards and
Yeah.
the legalese and
Mhm.
everything else. But building the case, it could be between 1 month and it could be up to 3 months. 6 months sometimes.
Mhm.
Because it really requires to firstly identify the right stakeholders.
Right. Maybe walk us through it a bit.
So
As
Yeah.
a founder, what am I looking at?
as a founder,
First, I have to find you
first
and choose.
you need to find the right vehicle to enter the organization. Let's say you go through the venture arm, and then you sit with the venture arm and explain and debate together what units inside the corporate will help you.
Mhm.
So let's say in my case would be a unit from the network side, a unit from, and that should be local and global as well, or a unit from a commercial side. Okay, who from those units is wholesale, direct to and then once you identify those stakeholders, then you approach them. Initially, the venture arm has a initial discussion with them. Most of the times, you don't get just introduced to those people. And as a founder, maybe a good advice here would be try to help your venture arm or sponsor from the corporate in front of you to sell you as best as they can. The last thing you want to do is, when you build something very complex, and you know very well what's behind the bonnet, to leave someone who just heard about you in 1 hour on a conversation, and then you expect them to sell it through. Just try to put more effort, send a forwardable email, send some documentation that it talks more about the corporate side, not the investment side, because that commercial or technical sponsor inside the corporate will not care that much about your investment round, right? So just make it as smooth as possible
Yeah,
for
they
your
care about your
sponsor,
business.
so you accelerate the time to the connection you need to get a green light from. So that person has an intro call, or sometimes just even an email. Then the sponsor will confirm if they're interested to hear more about it. And that's interesting, because if you would go alone, they will think you're selling to them. But then if someone from their organization goes and say, hey, I might be thinking to make a strategic investment in this company because this, and that, here's something I got from them. Give me an opinion, or at least sometimes it works, honestly, if you want to kind of do a proper DD and not grill them, but you know what I mean, just challenge them. They get more excited by that, which is cool, because if you trust the founder that is super talented and he knows his space, probably someone who goes with lower expectation and get reversed in their opinion about the startup, the effect really helps drive that deal along. So then, if the sponsor agrees, you organize a call, you let them discuss, you always pick insights from that, because you have to match those insights with another sponsor you're introducing them to, and you collect all of them and you create a case, a business case, and then with that you go to the investment committee.
Mhm.
So it takes a lot to do that. Depends how big, global is a certain corporate, how agile they are with this type of projects, how busy they are in that period of the year when you want to fundraise. Definitely don't go in November, when at least in the UK the budgets for next year and next 3 years are done, because everyone will be focused on that. Or depends. Every corporate has its own cycles of busyness or less busyness. So that also counts.
So as a founder, first of all, I have to sell to you, or somehow engage with you so that you like the idea. You being Wayra, the guy who is looking for startups, because that's your mission as part of the organization. But then once I have you on board, as it were, we together have to go to other stakeholders to see how this investment is strategic to the corporate.
Yeah.
Right. And that builds the case for the investment committee.
Yeah.
Which only then looks critically as an investment committee at the investment characteristics, round, whatever, financials and so on.
Those will be other stakeholders negotiating that.
Okay. So from these founders who approach you, what are the most common questions that you get from them? What are they worried about?
I think, as I said, they're worried that the corporate would sometimes maybe make them slower, or sometimes
and those conflict situations.
Those conflict situations. But most of the time, they want the corporate on board because it adds more validation to their journey. That's the minimum thing you can get out of a strategic investor. You go to your investor and say, hey, here's this corporate, they're investing in us. It looks something, I mean, show something rather than nothing, rather than an angel who doesn't have
Industry
like
knowledge,
industry
expertise.
knowledge.
Yeah.
It might have an angel, right? So don't get me wrong, but like it adds at least validation to the startup,
Mhm.
and at maximum all of the strategic benefits that we're
Yeah.
working with day to
Yeah.
day.
So again, that you get from founders.
So that's one. Then yeah, post investment. So post investment, in our case, we have a business development team that stays with the portfolio team and tries to help the startup navigate throughout the organization to land the contract, to land the partnership, align all of the stakeholders, drive the proof of concept. So that's very valuable for them. It's like an inside um, person that really helps them accelerate those lengthy enterprise contracts. That's number one. We also offer them fundraising support. We have an amazing agency inside our hub in London that are fundraisers in residence. So they sit with our companies and help them fundraise their next round. We do have a network of around 500 VCs throughout our 13 years history. We co-invested with a lot of VCs in 240 deals. So we do have that black book, but we do want the startup to be very well equipped when we open that black book to introduce them. That's another support. And then we also have coaches that we hire on behalf of Wayra, and then they sit down with the startups on various verticals from commercial, talent, product, and so on and so forth. So this is a package that we offer, plus sometimes some special procurement terms, for instance, which, you know, from a cash flow perspective, it matters for startups. Rather than 90 days, you're getting less. That's quite of a benefit. So that's usually how we discuss, and then we have to pinpoint on the strategic value in the end, and that's something they're mostly interested in.
So basically, what you would expect from a VC that is very operational and also has some strategic value in terms of also being a potential customer or a partner of some sort, which other VCs normally are not. Cool. Do founders often worry about things like compliance?
Yes, I mean, I would as well. It's not the easiest process to navigate, especially throughout the corporate. Requires a lot of patience, and what we do in our platform team and portfolio team is to make sure we're joining them and advising them throughout this compliance process and procurement process, and you know, the legal process, because it has to happen. This is how corporate operates. This is how they mitigate their risk. And the startups just have to have patience. And what we are trying to do is to help them accelerate, avoid mistakes that will take them longer than expected to land that contract. And of course, it is one of the big questions on their mind, especially if it's the first time they're dealing with a corporate. Which, from my perspective, from a founding team point of view, if your target customer is an enterprise, it would be ideal to have someone who have had enterprise experience before, knowing how to deal with all of these things, rather than being a newbie in this space. It will be way more painful for you as a founder. You can get our help, and we've seen outliers and examples that have proven this wrong. But in the end, the more you know about this space, the more successful you can be. So in a nutshell, I think founders really value the entrepreneurial conversation you can have with them, even you cannot promise anything, because so many things depend on your peers inside the corporate. They really appreciate the way you approach them, because most of traditional CVCs do have corporate people, which makes sense to that sit in that team. We also have some, but we also have this blend of entrepreneurs, former entrepreneurs. Our managing director is a former entrepreneur as well. We have one of the guys in my team is a former entrepreneur as well, myself, and many others former VCs. So we have a different way to empathize with the founder that they really appreciate. So it makes the front door softer for them. And I think sometimes that's very valuable. They really appreciate that.
Agreed. And I think there's a lot to appreciate about good CVCs. You're obviously there, so you like it. You think it's a good idea. And there are many reasons why entrepreneurs should pay very close attention to this type of strategic investor. I was wondering if there are any arguments against, such as, does it stigmatize you as a startup because you get the Telefonica label on you in your case, and of course it could be any other corporate VC, and then you might have trouble in the marketplace. This might limit you in some crucial ways. I can't quite think of it, but
Neither at the moment. Neither other than that with competitors
right,
of a certain corporate in a market.
you can't do business with a fierce competitor.
It's a hypothesis.
Mhm.
It's a hypothesis, and also depends what sort of influence. In my case, because it's a small ticket, I don't have a big influence over the startup's trajectory,
Right, obviously.
right? But a
Yes.
traditional CVC who has a board seat, who will have a voting power, that will be quite tricky indeed, and that will jeopardize your freedom in the market to go as widely as you want to everyone. Indeed. So you have to be very careful. The higher the amount you get from a CVC, the more responsibility will handle.
The more you are tied to
Yes.
that particular company,
Yes.
and therefore have less scope to do business
Yes.
with its competitors in
Yes.
its key markets
Yes.
and so on.
And I'll try to put. I mean, in the telco world, it's a bit different because you do have different geographies. So telcos could collaborate, and they very often collaborate, especially on the infrastructure, which is very expensive to build, and all of these innovations. But in other industries, it's a bit trickier. Like if you go to, let's say, a pharma company, but not the other,
Right.
right? So that definitely shuts your door. So that, yeah, indeed, that's something you
we
have to
have
be very
had
careful with.
a few examples in my experience of startups who were very excited to talk about to talk to pharma companies, for instance, but there did seem to be quite a strong incentive and interest on the part of the pharma companies to kind of grab them and keep them for themselves. So that didn't happen in that case. And there's also we have one example of a startup who took part in a hackathon, picked up an idea from a corporation, a business problem, started solving it, but then I think wisely chose not to get fully financed by that corporate. They remained a partner, customer. So they did a lot of great things together, but they didn't lock in. They didn't go for the lock-in in order for the startup to have access to a much larger market. So it's sometimes there can be to some degree a conflict there. But it's nice to see when they kind of resolve it in a way that works for both.
Yeah, and that's what we've been aiming for. To give you an example, one of our main KPIs as an organization is the amount, we call it FIT, is the amount of business we generate between the startups and Telefonica Group
Right.
companies. Just to give you an idea
How do you measure it?
aligned in number of contracts, the value of contracts.
Okay, so you measure it in already realized, or do you also do projections? I guess you need to do projections to begin with.
Yes, we do that. So to give you a number, across all Wayra hubs in all the territories we have a presence in, I think we have surpassed 600 million total FIT value, and we're aiming to hit 1 billion by 2025.
That's nice. So that's basically part of your KPIs, I would imagine.
Yes, yeah.
How much of this did you generate?
Don't know exactly now the number. So we have the business development team who drives it.
Yeah.
We're more on the investment side and the corporate side to identify the opportunities. An interesting way to put it is that we have two ways of looking at startups. So one is inbound. So most VCs who look at deals and they think there's interesting for a telco to look at, they recommend us. We probably get like 20-30 deals a month, and this is what we call inbound, which is obviously a bit harder to land because it takes longer to identify all of the stakeholders, right? But it's interesting as well, and I will never shut that door. But we have another interesting aspect, which comes more from the open innovation services we do, which is sitting down with a certain business unit, understand their roadmap, understand their strategy or their challenges, define them into a scouting thesis in a workshop we organize together. That sometimes we even bring VCs and different industry experts. We go in the market and look at the entire market from a 360 perspective, and then we identify the best startups they could work with. So we're very proactive in finding the best startup for a certain problem that the corporates have, and that really helped us, coming back to your to the fit number, predict better and have a better corporate startup fit, if I can call it like that, that will generate impact throughout the years, rather than pushing it from outside, which obviously whenever you push there is resistance, whenever you pull there's better there's a better way to approach it.
You also maximize your chances of a good fit.
Yes, and you can see, since we changed this model and we changed from the accelerator model to this model we're doing today, we managed to land deals that have way bigger impact than a proof of concept had back in an accelerator space. So we were super happy when we had an accelerator. We were like, yeah, a POC, or if all 10 startups will land a POC each, everyone will be happy. Here we start being happy at the 10 million deal. So in terms of commercial impact.
Right.
So just to give you a perspective of how different it is today.
Yeah, whole different scale.
Yeah.
Okay. Maybe let's summarize. You're a founder. What do? You're, first of all, you should consider your roadmap to unicorn status, right?
Yes.
And on that roadmap, you should fit some solid strategic investors.
Yeah.
We talked about the different types. What do you do to find them?
You map all of them, put their LinkedIn profiles up, both commercial or different units you will need access to, and the venture arm. Depends how big or active is the venture arm. Look at the portfolio companies they have in the they have, even talk to them, and then decide if you would go first with the commercial guys to approach or through the venture arm. My recommendation would be through the venture arm, but if you don't have any hypothesis at hand, at least find someone that is very startup oriented. For instance, I look at different corporate sponsors from other corporates. If they have a startup advisor role, if they have been a mentor and accelerator in the past, that's already a sign they appreciate this space, and they will appreciate someone like you coming to them for advice and guidance. So then you have your hypothesis, you go to them, and then explain the value to the corporate arm, the strategic value you can both capture together, because they will be happy if you do way more than the financial return, obviously. So it's also their interest to help you with that, and then they will open up the gateway in the corporate, set up the meetings, put together a business case, show value, and then prepare for the IC, the compliance, the procurement, and all of the thing that follows through the navigation inside the corporate, and driving that value for both sides. I think that's in a nutshell the process I see.
Well, and of course, having this kind of partner as an investor, just switching sides now, we always have really appreciated having both other angels, people with experience, and VCs, and of course corporate VCs, because sometimes they really do make sense, on board, because they bring all this extra value, other than just money, which is identical to the mission of a business angel. So I can really feel that.
Yeah.
Even though it's done differently on a different scale and in a slightly different way. So thanks very much for this input. We are still, and I hope the noise wasn't too much for our audience, we are still in this extraordinary location that kind of always reminds me of Berlin.
Yes. You're right.
in Timisoara, which is where the conference will be at the end of the month. So we'll be seeing you again soon.
Yes.
And the conference is aimed at business angels and business angels wannabes, in the sense that there are a lot of investors who haven't yet tried their hands at this special asset class, early stage startups, moonicorns, as we call them. So we'll be talking about the ins and outs of angel investment, starting with the why. And I think the why transpires in throughout all of these conversations, because the why of a corporate, while you could say that ultimately it's about I don't know, making more money, for through by working with startups and generating more value, it's actually very rarely only about that. When you look at numbers, you see that. But even for corporates, and certainly for angels, yes, that's an important layer. But then there's the element of engagement and of creating value in communities, in society, which is really amazing. The kind
It
of
is.
energy that you feel with these people, between you, a corporate, you don't look it, by the way.
I'm not. I'm part of a venture arm.
Right, exactly. The energy between a corporate, as it were, and an entrepreneur, a startup, can be amazing, because you're creating things together.
Yes, and one closing remark on my end for any other corporate out there is to really develop their open innovation efforts, their corporate startup collaboration efforts, because the market is going towards that direction.
Mhm.
I seen actually a report from a big consulting firm that was forecasting that by 2030 it will be the first time where Fortune 500 companies, global R&D budgets, would be the startups taking more than half of it.
Wow.
Yeah, and it makes sense.
Mm-hmm.
From my point of view, what I'm seeing is that, okay, if I'm a corporate, which traditionally it's very difficult to build products inside.
Yes,
It's very
they become organizations become more and more rigid as they
Exactly.
grow.
yeah. And then I'm a corporate. I need to build a product, right? I have a certain product roadmap. Do I choose to build it internally? Do I choose to get a third party to build it? They have certain risks and kind of ingredients. But then why wouldn't I go to a startup who has an amazingly and talented team that has gotten that idea up to a growth stage, validated by several other corporate
Mhm.
customers,
Exactly.
a learning and failing and learning again throughout their journey at the different speed that I can do, and backed by so much capital and investors that would validate and support them throughout the journey. So that will accelerate my go-to market. That will decrease my capex investments.
Right.
That will always keep that technology up to date, because let's not forget the technology, the tech debt that and the maintenance that corporates have to do with all of these huge legacy systems. And there's so many benefits out there. It's just to have enough trust and educate your procurement department and have a venture arm to manage to accommodate these new types of players which are taking the world nowadays.
Yeah.
And you guys have so much involvement in that early stage that's so important.
Yeah. Well, thank you for being here.
My
Because
pleasure.
we're not on Zoom, we can stand
yes,
up and
yes.
shake hands.
Yes,
Thanks very much.
my pleasure.
And we look
as
forward to
always.
seeing you soon again.
See you in a couple of weeks at Invest in Unicorn. Yes.
Yeah.
See you.
Cheers. Bye. Thanks.